Hello and welcome back to my office. I've got a question for you that is very strange. I think it will have you scratching your head a little bit. It goes like this. Do you know your work address? Yeah, there we go. Do you know your work address? Now on the surface you might be thinking, well, I work in such and such a suburb and this is my street address and of course I know my work address. This is not that question. This is that question but a different question. So hang around and I'm going to see if I can explain to you what your work address is.
Let's get right on into talking about your work address. So as I suggested in the introduction, this work address is not the physical location that you pitch up in the world, but rather your address in the income statement and balance sheet and that part of the business that you have an influence over. So before we can answer the question about what is your work address, we need to establish the playing field or the neighborhoods that are relevant to the question. So let's dive on in here. This is my very simplistic Excel spreadsheet that will help us. On the left hand side here we have, in my highlighted box, what we would consider a typical balance sheet as provided to us by accountants. Now excuse my language, first up, I'm a little bit old school. I haven't made the transition to this new aged fandangled terminology that accountants talk of these days. So my terminology here is a little antiquated, but I suspect many of you out there are in the same boat as me. So let's see. We have some equity, some money from shareholders. We have some long-term debt, some stuff that accountants now call non-current liabilities. And here are some current liabilities. Think of that as primarily money owing to suppliers. So if we add these all up, we have a number here which is called the total liabilities, if you want. On the other side of the balance sheet, we have a number of assets that are made up of fixed assets, property, plant, equipment, all those sorts of things. Accountants don't call them fixed assets anymore. They are now called non-current assets. All right. Included in non-current assets are also, for the sake of our example, investments and loans and intangible assets. Next up, we have some current assets. Think of this as stock on the shelf and money owed to us by our customers. Now, typically cash is incorporated as a current asset. I have specifically put it out here on its own. So the principle is here, you can't have any of these assets in the business without first raising some liabilities from some source. I changed the playing field because I don't find this very user-friendly in terms of the way I think. I think like a finance person, not like an accountant. So how do I change it? Well, what I do is I take these current liabilities here and I move them onto the other side of the balance sheet. And when we say current assets minus current liabilities, what happens is we get a number here, the one minus the other, that is the net current assets, or in my lingo I like to call it working capital. So head over here to the right hand side and let's look at what our balance sheet now looks like when we make this adjustment. Current liabilities off to the other side now makes up this thing called working capital. Here are fixed assets. Remember, fixed assets, it's investments and loans and intangible assets in there. And if you want to be pedantic, it's right of use assets that are also in there, these new lease things that we now have to deal with. On the left hand side, which I've changed the name to capital, equity plus debt, and on the right hand side we have the operations, which is really the assets that work for the business. Subtle adjustment, but a significant change in how we look at the business. No longer are we talking assets and liabilities, which is the language of accountants. We're now going to talk capital and operations. Why did I make this change? Because these current liabilities, although they are liabilities and it's money owing to suppliers, it might also be overdraft, it might be outstanding taxes, typically this money has no cost. Now, of course, someone will pick out the fact that if I have an overdraft, there is a cost. Yes, correct. And in fact, this long-term debt, when I calculate it on the balance sheet, it is long-term debt plus overdraft funding in order to get the debt to equity ratio. But the principle of these current liabilities is it's mostly money owing to suppliers that has no cost of capital. So hence, I'm taking it and putting it on the other side of the balance sheet. So then what we are left with here is capital that has a cost. That helps us when we're measuring our returns later on, because we want to know what is the weighted average cost of capital. Right, now that we have the playing field, let me ask you my question again. What is your work address? And now I want you to think of it as if the capital side of the balance sheet is the capital suburb, to use the terminology that goes with an address. And this side of the balance sheet is the operations side of the business. Now, which suburb do you work in? Do you work in the operations suburb or do you work in the capital suburb? I'm going to suggest to you that it's highly likely that you work in the operations suburb, because that is the area where 99% of the employees of the business are situated. You have a responsibility to utilize these assets and resources in order to generate sales in the income statement. Those people who operate or work in the capital suburb, they are responsible for the dividend policy around how much dividend gets paid to the shareholders on an annual basis. Those who work in the capital suburb are dealing directly with financial institutions around the amount of debt funding, the time span or the term of that funding, and the relative costs, and different types of funding. So there's different levels of long-term debt in the business: senior, mezzanine, short-term, and it can get more complex. But that is a whole unique side to the debt structures of a business, and those folks who deal with that are typically the CFO, the CEO, and other senior members of the board of directors. It's a very few in number relative to the number of people in a business. Hence, most people find themselves in the operations suburb. All right, cool. Let's move on to my work address tab here. So now that we have determined that you are most likely in the operations suburb, what I want to do is I want to head across to the income statement and find out what your street address is. And you'll see that my income statement has been broken into operations and capital, just like the balance sheet. And the point where it is delineated between operations and capital is just below the profit before interest and tax, or EBIT, which you probably more commonly know it as, or the operating profit. Now, is your street address sales street? Are you dealing directly with the customer? Are you responsible for making the sale, closing the sale? I would put you in sales street. You might be the sales director. You might be managing a sales team. I will also put you in sales street if you are part, or if your responsibility is advertising and marketing. The intention of those two functions is to attract and communicate to customers about the products and services of the business, hence is sales. Are you in cost of sales street? Cost of sales street is about the manufacturing of the product or the delivery of the service to the customer. There's also a delivery component in the logistics of getting the product to the customer. That's going to be in cost of sales street. Procurement is in cost of sales street. And the other component of cost of sales street is typically quality control, definitely in there. There might also be an IT component that's in cost of sales, but typically the street address in which I put the IT function is here in expense street. Strictly speaking, as far as the accountants are concerned, everyone is in expense street because that's where salaries are recorded in the business. But in the context of my analogy about our work address, expenses is the location where those who support the functions of sales and cost of sales or delivery of the product, they reside in expense street. Let me say that again. Expense street are the people in the business who support those who are in sales street and cost of sales street. Expense street is made up of typically an HR function, people management if you want. It's made up of a legal function, also an IT function, and there might also be certain other admin services and accounting services that are in expense street. Let's call it a catch-all for those who are not customer facing in sales and those that are not strictly production in the cost of sales. So I'm hoping now you have been able to identify the suburb that you work in and therefore the street address that relates to what you do in that suburb. If you find yourself in the capital suburb, well, of course, the interest expense that relates to the debt and the dividend down the bottom here that relates to the equity are very important components in your world. However, the responsibility of the CEO, who I put in the capital suburb, actually has a responsibility for the entire organization, and one might suggest that the CEO lives or works in the capital suburb and the operations suburb and has a house on every single street of the income statement, hence the broad responsibility. So why do I do this? Well, for most people, for most mere mortals who are not accountants or who are not financially literate, helping them understand the balance sheet in a simple term that relates to their work address, to show these folks how they influence the income statement and how they influence the balance sheet, gets them ready for the conversation about how is it that they add value to the business, where do they add value, and how can they contribute to the value creation proposition of the entire organization. And that value creation, you will find more information in my book, The Secrets of Business Performance and Value Creation, where you can follow the link below and get your free ebook copy. And of course, this subject matter is covered in my book if you want to get some more information on that. So well done, you now have established your new work address. Perhaps it's your existing one. Let's talk about how knowing and understanding your work address can help us analyze the performance of Woolworths. So here we have in our very busy diagram on my spreadsheet here, we have 2 years of financial results. On the left hand side we have the year end 2019 and on the right hand side the year end 2020, most up-to-date data for Woolworths. Let's start off with the balance sheet and you'll see immediately that this is in capital and operations type of terminology, and under equity we've got a little over 9 billion in equity and a little over 13 billion in long-term debt. Add these two together to get a total capital number of 22.4 billion rand. Of course, what's in capital must appear in net assets for our balance sheet to balance, and the net assets are made up of, here we go, fixed assets 14, nearly 3 billion, 7.2 billion in intangibles, 800,000 in investments and loans, and 2.2 billion in working capital. That's a large working capital number because of course Woolworths has lots of stock on the shelf. Alright, so what's your work address? Well, those people in the operations of Woolworths are managing 22.4 billion rands worth of assets with the intention to generate sales. 22.4 billion rands worth of assets are generating 75 billion rands worth of sales. I refer to that as the activity measure. And if you look at the maths here, what is 22.4 billion times 3.35? It gets you to the sales number. It's a factor that measures how well you use your net assets to generate sales. and therefore I can measure your performance year in, year out in the operations. We can fast forward 1 year and we can see in the following year in Woolworths, using 20.8 billion rands in assets, 74 billion rands in sales was generated. The activity went up because, in fact, they are working off a lower net asset base. There was some impairment of assets to get down to that lower number. So you might say that the operations have been more efficient, but only because they've written down the value of assets because they actually paid too much for them when they bought them several years earlier. So that's the activity of the operations. Of course, measuring the profitability of the operations, here we go, 5.1 billion measured against 75 billion in sales gives you a profit measure of 6.8%. All right, so let's put these two together. A 6.8% operating profit plus 3.3 as an activity gets you a return on net assets of 22.8%. Is that good? Well, it's good because it is more than the cost of capital. And if you generate returns that are more than the cost of capital, you are creating value. Well done to Woolworths. They are creating value. I might add, that is a turnaround from last year when they were destroying value. I will show you more on that in a moment. Turns out that a year later, 22.8% return on net assets is essentially the same, give or take a small rounding error. So Woolworths is definitely creating value. Let me take you back to my Valuation Excel spreadsheet that looks like so much data. It is overwhelming. But what I'm going to show you is a unique little number here called EVA, Economic Value Add, and I'm going to show you how in 2018 Woolworths had a dreadful year. How do I know that? Look at their return on net assets, they're negative. Look at their value creation, it is negative. This business made losses in 2018, mostly because they had to impair 6 billion rands worth of assets that they bought in 2015 when they did the David Jones deal, where they completely overpaid for these assets. So eventually the accountants told them to take that value off the balance sheet and write it off as an expense in the income statement. Ouch! But since then, Woolworths appears to be able to get back on the path and is now creating value again and generating returns that are higher than their cost of capital. One thing I want to show you about my spreadsheet, keep you coming back for future videos, is what if we take Woolworths and we put in there SHP for ShopRite and we ask Excel to go and get some more data. You will see my spreadsheet will immediately update. It will come back with the ShopRite data and you can see, look at the sales numbers here. 145 billion, 149 billion, and in 2020 159 billion. And my little Excel spreadsheet does a calculation, a rough and ready of what is the value of ShopRite at the moment, and I have the value of ShopRite at 125, rough and ready dipstick, but the current share price, a little bit outdated here, this is the 22nd of February, is 141 Rand a share. If we go back to Woolworths, we will be able to see, give Woolworths a moment to update and do some calculations. It's going off to my MS Access database, drawing out the numbers, bringing it back to the spreadsheet, putting them in the spreadsheet, doing a calculation for the valuation of Woolworths, and it's saying to me, here we go, if the share price at Woolworths is now 46 Rand, the value is round about 40 Rand, rough and ready as far as valuation techniques are concerned. Now, if you wanted to build this valuation spreadsheet, you just have to go and do my Excel course. So it's called Valuation on Excel Steroids, and I'll put a link below and I'll show you exactly how you can get access to build this spreadsheet and do the valuations and understand value creation in all its glory. We'll see you on the far post.